Imagine paying more for local petrol than the same product imported from across the border, fuel you helped produce. That's happening now in Nigeria, and it's forcing Dangote and fuel importers into a fierce showdown with ordinary drivers hanging in the balance. Dangote Refinery has reduced its ex-depot, gantry, price for petrol several times. One major cut was 65 Nigerian nairas per litre, from 890 Nigerian nairas to 825 Nigerian nairas. Importers have responded. The landing cost to bring in petrol, including shipping, duties, etc., for imported premium motor spirit, PMS, has dropped to around 922.65 Nigerian nairas per litre, which in some cases is lower than Dangote's earlier pricing from the refinery gantry. Pulse Nigeria. Some private depots and importers have even been offering petrol at prices below what Dangote is charging, creating a price war. In some states or depots, sellers have offered PMS at 820 to 840 Nigerian nairas per litre, while Dangote's price was higher in the past. Why this price discrepancy matters? Competition and relief for consumers. With importers able to sell cheaper than some local refined prices, consumers have opportunities for lower pump prices. This could ease transportation costs, cost of goods, inflation, etc. Pressure on local refiners. Dangote, despite being a major refining setup in Nigeria, faces the challenge of matching importers' prices. Local refining must contend with exchange rates, production and operational costs, duties, etc., which sometimes push its prices above what importers can manage. Market distortions and policy implications. If imported petrol remains cheaper, it could undercut local refining investments, but also push local refiners to be more efficient. It raises questions about fuel import bans, subsidies, government regulation, and how transparent pricing structure is. How Dangote has responded and what they've done. Aside from slashing prices, Dangote announced a refund scheme. Marketers who bought petrol at a higher price before the reduction, when gantry price was higher, were to get refunded 65 Nigerian nairas per litre for the excess. Dangote has also been cutting prices in stages, not just one big drop but incremental reductions. For example, from about 890 Nigerian nairas to 825 Nigerian nairas in one case, then possibly further. These reductions are clearly responses to both global influences, oil prices, exchange rates, and domestic competition from importers and private depots. The importers vs local refinery competition. Importers are now more attractive when their costs, landing cost plus distribution, drop below the ex-depot price of Dangote. Some marketers have publicly said they are shifting to importers' supply when it's cheaper. Pulse Nigeria. However, dependency on imports comes with risk, foreign exchange volatility, shipping and duty costs, supply chain disruptions, etc. Local refineries like Dangote have advantages in proximity, but also have higher fixed and operational costs. Risks and challenges. Profit margins thin for importers. Selling below cost or near cost puts importers at risk, especially if there are delays, higher duties, or FX fluctuations. Quality and safety oversight. Lower prices should not compromise quality. Refined PMS must meet regulatory and safety standards, otherwise risk downstream issues. Regulatory uncertainty. Government policies such as possible bans on importation, as sometimes discussed, or sudden changes in duties or taxes or regulatory fees could disrupt this balance. What this means for Nigerians. Lower fuel prices potentially. If importers maintain cheaper pricing, pump prices across the country may reduce, benefiting transport costs, goods prices, inflation. Greater consumer choice. Consumers may prefer stations that import if those are cheaper. Dangote may need to further reduce for local switch. Policy pressure. Pressure on government to ensure deregulation works in favor of consumers, ensure transparency, reduce inefficiencies. What needs to happen next? Dangote and other local refineries need to continue improving efficiencies, reducing production or operational cost, leveraging scale, reducing dollar costs to compete. Government should ensure fair competition, not impose undue burdens on local refineries while allowing importers to thrive without regulation. Monitoring of pricing, preventing profiteering, where petrol is bought cheaply but resold at high pump prices, transparent reporting by marketers. Consider subsidies or tax incentives for local refining, or ensuring duties on imported PMS reflect fair competition. Government should ensure fair competition, not impose undue burdens on local refineries while allowing importers to thrive without regulation. Monitoring of pricing, preventing profiteering, where petrol is bought cheaply but resold at high pump prices, transparent reporting by marketers. Conclusion, opportunity or warning. Dangote's price cuts and cheaper imported petrol have opened a window of opportunity for relief for Nigerians. But also a warning, local refineries must adapt rapidly, markets must remain competitive, and government must stay hands-on to ensure consumer benefit. If this competition persists, Nigeria could see a more stable, affordable fuel market. If it falters, imported petrol may dominate, local refineries lose investments, and consumers may continue to suffer from unstable and inflated prices. Key summary. Dangote cut petrol price by about 65 Nigerian nairas per litre to undercut importers or respond to competition. Landing cost of imported petrol, PMS, has dropped, sometimes cheaper than local refined product from Dangote ex-depot. Marketers are shifting suppliers, importers undercutting local refinery, price war underway.
Thanks for watching. If you enjoyed this update and want to stay informed with fast, reliable news, don't forget to subscribe to Newsflash 360. Hit the notification bell so you never miss a story. Your next headline is just seconds away.